Good morning. Welcome to the Bipartisan Policy Center. We have overbooked ourselves today. We have 3 events here, so we're going to go kind of fast through this, but we will end on time here this morning with our first panel. Again, good morning. I'm Bill Hoagland. I have the pleasure of working with our economic and financial team on some of the fiscally challenging issues that we confront as a nation. But I'll be the first one to admit here this morning that today's discussion, reference rate reform, is rather wonky, complicated, and somewhat technical, particularly to someone uninitiated as I am. So I am particularly pleased that this forum is being sponsored with the International Swaps and Derivatives Association, ISTA. It's a group that understands this issue much better than I ever will. And we'll be joined shortly here with Scott O'Malley, ISTA's chief executive, help lead a panel discussion on this, on the future of reference rates. But what I have come to understand, I think, is the fact that one key reference rate, the London Interbank Offering Rate, LIBOR, it's used to set an array of interest rates to price billions, if not trillions of dollars in derivatives, syndicated loans, business and retail loans, floating rate loans, even student loans. That's going, I think, is basically going out of business by 2021. And an alternative benchmark is needed, which our Federal Reserve has been creating over the last 2 years, another acronym, SOFR, Secure Overnight Financing Rate. So why does BPC focus on this somewhat technical issue? First, one would think this should be a purely nonpartisan, bipartisan issue, but it seems today every public issue carries some partisan connections, and we think, therefore, that we want to make this a bipartisan fix that everyone should support. Second, it's not only the impact an alternative reference rate might have on the financial instruments outstanding today, but the impact an alternative benchmark would have on the average American on Main Street, a theme that we'll continue throughout today, including adjustable mortgage rates, credit cards, and, as I said, student loans. Now, if you're a homeowner in Terre Haute, Indiana, and your mortgage interest payments is linked to LIBOR, what happens if LIBOR goes away without an alternative to replace it, and your contract does not take this very real possibility into account? These are the kinds of questions we want to address. Many in government and industry have studied this issue, and as I say, over the last couple of years have developed a more liquid alternative, as I mentioned so far. However, we can't be complacent now that we might have an alternative. We need to act to ensure that there's a smooth transition to that alternative. And so making sure we get this transition right is why BPC and ISTA are hosting this event today. To discuss these and I'm sure other issues in the news today impacting the future of financial markets, we are honored to have the chairman of the Securities and Exchange Commission with us this morning, the Honorable J. Clayton, and to moderate a discussion with the chairman, the distinguished CNBC editor-at-large covering Washington politics and finances, an old friend, a friend, we won't say old, a friend of many years, John Horowitz. So John and Mr. Chairman, please join us. And as they come to the stage playing on the Main Street theme, know that the chairman was born in Newport News, Virginia, and John in Louisville, Kentucky. Both, I think, qualify as Main Street towns. So, John, turning it over to you.
Thank you. Good morning, everybody. Mic works?
Yes.
So, how is life at the Short Seller Enrichment Commission?
That's an old joke.
We had a very turbulent, well, it's an old joke, but
well, at least
is it a good joke?
It's a week old, right?
Okay. We had a turbulent market day yesterday, and the president has come out over the last, 18 hours or so and said the Fed has caused this to happen. The Fed's wild. Fed's, crazy in raising interest rates. What do you think about that? Any concern about the market this morning as it opens right now?
So the market.
Mm-hmm.
Look, one of the things about the SEC is we want markets to function. Now, whether they go up or down on a day-to-day basis, a week, that's not for us to comment on. We don't conduct monetary policy. We don't conduct fiscal policy. We try to define a rule set that makes markets function for all the participants as well as they can. Days like yesterday make people nervous because obviously it's not expected when you see drops like this, but drops like that are part of the way markets work. My question last night for our team was, how did the market function? How many limit up, limit downs? Were there, what I would say is jumps that were out of the ordinary or discontinuities or things like that? And, the assessment overall was the market functioned well. It digested new information, new ideas, and, functioned well. And that's our primary concern. So, look, I don't want to say everything is absolutely fabulous or anything is wrong, but yesterday, in a highest volume day in a long time, the market functioned well.
And beyond yesterday, any broad concerns looking at the market on how it functions, whether it's the amount of volume in ETFs, the way algorithms work and exacerbate moves in one direction or the other? Are you content with how?
I'm never content. I get paid to worry.
Right.
So
what are your biggest concerns as we sit today?
Well, there are functioning concerns. There are issues in the, I would say, in the macroeconomic sphere that we're going to talk about. One of them is the transition to LIBOR.
Right.
Another one is Brexit. There are things like that that are of concern.
But functioning, functioning concerns.
In terms of function, I do worry about things like what has changed in the market in terms of concentration. Concentrations are areas where you should look at them and ask, are they creating concerns?
Which concentrations are you referring to?
Well, let me give you an example. Yeah. If you have a narrow piece of the market that has high concentration and there's an issue, you're likely to get a quite amplified result. We saw that, if we were here on February 6th, it would be a lot like being here today, because Feb 5 we had a big drop, and there were what I would say is outsized moves in the volatility space. Now, that's a space that fairly narrow, small set of products. Those are the types of places that we look at and say, is that really how our market should be?
So are ETFs a particular area of concern?
I don't want to call out ETFs as an area of concern, but what I'd like to do is look at the market as it was 5 years ago, 10 years ago, and see where it is today. And obviously, there's a greater concentration of ETFs. And it's funny, you say ETFs, they come in all different shapes and sizes. Would I be, particularly concerned about a broad-based basket ETF? No. Do I look at narrow aspects of the market and look at products in narrow aspects of the market and say, is that something we should look at more closely? Yes.
Any in particular?
No, just that's, you're asking me to.
Yeah.
I'm being very candid about how I look at things.
All right. I may come back to the market later, but let's go right to the six. LIBOR.
Okay.
Tell me what are your concerns about the transition to a new reference rate?
That it's such a big job, touches a lot of things, and it clearly is going to happen. It's not like this isn't something we need to do. I mean, you're going to have experts here to talk about where we are, but I'll try to encapsulate it. They can correct me when they come up. We have a reference rate for interest rates that go throughout our economy. That is not based on what I would say is a highly liquid or market that we feel good about. Right? It's not a market LIBOR is not a market that trades a lot. So we're going to transition away from a market that doesn't trade a lot to hopefully a market that's more representative of what's happening in our economy. I think that look, we're not the primary responsible party for identifying the alternative reference rate. I think they've done a good job in picking something tied to, overnight treasuries. Now the question is, how do we implement that? How do we execute? And it's a big execution job.
How bumpy will that transition be? And if you're my brother, who's an airline pilot in Cincinnati, Ohio, how will he notice it, or any ordinary family?
So how bumpy will it be? Again, speaking for myself, and I always need to be clear on this. I am speaking for myself, not for any other commissioner. Speaking for myself, how bumpy will it be? It's fundamentally a market issue, and I think one of the big factors in how bumpy it will be is how comfortable market participants are with the alternative rate. So, if the alternative rate begins to pick up traction, we have lots of products that are being based on the alternative rate. It makes it easier to transition from the old to the new, right? Because you have a functioning market, and I like. Look, there's a lot of work to do, but I like that we're getting started on moving products into the alternative rate, so that you can know what the transition is going to look like. If I just say to you, hey, we're going to change to this new rate that no one's using, you'd be highly skeptical. And also, it might bump around a lot more than if people are using it.
Right. So what do you think it would be the biggest source of resistance from the new rate as you understand its design?
I think we'll have to wait and see. I mean, right? There are going to be people, like in any time you have a transition, there are going to be people with a vested interest that feel that the transition is either good for them or bad for them. If we can narrow the number of people who think it's bad or good, we're going to do much better. Does that make sense? If I'm sitting there with a LIBOR-based instrument and I think transition to SOFR is going to cost me money, I don't like that.
Right.
If I think it's going to make me money, I like it. We probably want to, have as many people say, this is better.
Right.
Very few people who say, this is bad for me. One good way to do that is to have a functioning market so that you can design the transition so that it makes the most people in that zone where I'm better off going here than I am trying to stick behind.
And what about my brother in Cincinnati?
Look, I think your brother in Cincinnati, and so I'm going to digress. We've been going on a town hall tour in connection with something completely different, which is the standard of conduct that investment professionals owe to your brother when they deal with them. And the common theme in all these town halls, people come up to me and say, hey, Jay, one thing, we have to educate people better on how our markets work. So what I would say to your brother in Cincinnati is, this matters because although it's, transactions in the millions and, hundreds of millions of dollars that reference this, it does come down to your mortgage, your credit card. And the better markets function, the lower your rate's going to be on a relative basis. So, they want us to get this right. Said another way, a lot of volatility and uncertainty filters its way to the consumer market pretty quickly.
Now, you're talking about the effect on mortgage rates. What is your feel for the pace of interest rate rises now and the effect that's having on the market?
I'm so happy monetary policy is outside my purview.
So you're not here to say the Fed's gone crazy.
Nope, I'm not here to say that.
You talked a minute ago about narrow slices of the market. Let me ask about ownership of equities in the market. Are you concerned that that is too narrow from a couple of standpoints? One is, there was somebody calculated recently that 10% of Americans own 84% of the equities. You've also got twice as many privately held companies as you do public companies. Are you concerned that the ownership of public equities is too narrow?
Well, I think there's two things tied up in what you're saying. One is what percentage of our households participate in our markets? And I believe particularly the way we've moved toward defined contribution plans and the responsibility to save for your retirement on your own. Broad participation, I'd like to see it broader. I would like to see participation in our markets for the long term be broader. And then another slice of your question is, when retail investors participate in our markets, how broad a spectrum of investments do they have? I think that spectrum has been getting relatively smaller because we have fewer public companies. Companies are waiting much longer in their life cycle to go public, which by definition means that retail investors have less access to the market as a whole, and I fear less access to companies that are well established but still growing.
So that's a problem.
That's a problem.
What are you going to do about it?
We're doing we've already done a fair amount to try and make our public capital markets more attractive to companies in that phase. And then another question is, do we do more to provide retail investors with access to non-public companies? Now, I've said that, and people have said, oh, you want to lower I would say the gates or the standards that we put up for the technical term is accredited investors. You want to make more people accredited investors. You want to let more people. Not necessarily, but are there ways that we can give retail investors access to what people refer to as private equity or venture capital, where we haven't lessened the investor protection? I think that's something we should be looking at. Now, I don't have a specific proposal, but I can tell you, like back here at night, I'm thinking about how can we do that in ways other than changing the accredited investor definition.
And what can you do to persuade more companies to go public and go public earlier in their life cycle?
Well, it's an economic question for them. Does it make sense for me to be a public company? One thing I don't want to do is change our private equity markets. If you talk to people in Europe about the U.S. recovery from the recession versus the European recovery from the recession, what most people will tell you, and is a pretty common theme, is the nimble nature of our private capital markets greatly facilitated the U.S.'s more rapid emergence. So our private capital markets are good. I'm not gonna put more burdens on the private capital markets to force people into the public capital markets. That would be a mistake. But can we do things to make it more attractive to join the public capital markets without in any way reducing investor protection? I am not a subscriber to the view that making the public capital markets more attractive necessarily means you've reduced investor protection. That's a false, binary view of the world. You can make it more attractive without reducing investor protection.
Let me ask a basic question about your resources at the SEC. Are you comfortable with the amount of resources that you have to protect investors? Because there's some people who worry that the SEC's understaffed.
So look, I take a pragmatic view. When I got to the SEC, it took me a fair amount of time to say, do we have too many resources? Do we have too few? Are we deploying them appropriately? Are we not? Now, I feel I know the agency well enough that in our most recent budget, I said, look, I'd like enough money for some more IT and 100 or so additional people. I know that I can put those 100 or so additional people to very good use. As we look out to the next budget, I think that on top of that—
Have you gotten those 100 people?
It's working its way through the process. Can you help me? If you know anybody, make some calls. And as I've looked out, and I just, I think that in subsequent years, I can see incremental additions that would help.
So you do need more.
Look, the word need is sort of a, can I put more to really good use? Yes. Yeah. And that's the question.
Let me run through a couple of issues before we get to questions. Cyber attacks. Are you satisfied with the current standards for when companies have to report cyber attacks, or do you think those need adjustment?
So what I said when I originally got in this job, and I think it's gotten a bit better, but I'm still not satisfied, is that the general disclosure, I'll say general, and then I'm going to break it into two parts. The general disclosure in the marketplace around cyber risks is not where I would like to have seen it. In terms of, two aspects. One is, hey, here's how dependent my company is on data protection, the use of data, and therefore its vulnerability to cyber. Would have liked to have seen better disclosure. And then around specific events, would have liked to have seen better disclosure. In terms, but I think sometimes people mix this up. There's disclosure from the point of view of the markets and investors, and then there's disclosure from the point of view of consumers. I think now we are starting to understand that those are two different things, and consumers may need disclosure long before investors need disclosure. Investor disclosure is our bailiwick.
Right. But you think that there needs to be an adjustment, a lower threshold for investor disclosure, correct?
I'm not saying there needs to be a lower threshold. I'm saying that based on what our rules are today, I think it can improve. And we've told the market that. We've brought some actions against people who have not disclosed as they should under our rules. And we're going to continue to do that.
And do you see market participants
I see them-
adjusting to that
People
caution?
things have improved. General disclosure has improved. I think people are disclosing incidents that may have an impact on investors sooner. The consumer disclosure and the investor disclosure are not isolated from each other. When you make consumer disclosure, sometimes that drives investor disclosure. It's getting better. But I still don't think the American public has an appreciation for how dependent we are on data for lots of things in our everyday life, and therefore how vulnerable we would be to a significant cyber event. I wish the public knew more.
Yeah. We talked a few minutes ago about ETFs. Are we going to see a Bitcoin ETF next month, or is the caution from the IMF and others going to dissuade you from going that direction?
So you're asking, let me break this into two parts. You're asking about a specific product approval. I'm not going to comment on, that process, but we do go through a process around products that has, many aspects to it. And actually, I've put out statements on this, or the commission has, so we've been pretty clear about the types of things products need to have, including markets that we're comfortable can't be easily manipulated. Switching to, the crypto space more generally, I'm happy to see that Senate Banking's having another hearing on this today, because there are a lot of issues in this space to discuss. I've been on record that the technology is technology that has promise. I've also been on record that these are markets that, while they appear to look like are regulated and well understood markets, they do not function in the same way that our regulated and well understood markets do. And investors should be very cautious that a quote of a price in these markets does not carry with it the same level of confidence and scrutiny that a quote on the New York Stock Exchange or the NASDAQ or some other market does.
Well, let me just try one broader question, not about the one you're considering right now, but let's say you look 2-3 years down the road. Are there going to be Bitcoin ETFs?
I don't know. What do you think?
My thoughts are derivative of your thoughts.
Well, and an ETF is kind of a derivative, right? I can't handicap it.
Any concern about pot stocks?
You mean like marijuana?
Cannabis?
Yeah.
Being listed on the U.S. exchanges?
I would say no specialized concern.
As opposed to what?
Yeah. Again, I'm not going to comment about specific products or companies. That's not appropriate.
Where do you think things stand with the issue of whether quarterly guidance needs to end, whether quarterly reporting needs to end to discourage short-termism. Obviously, the president's gotten interested in that, and so have people like Jamie Dimon and Warren Buffett.
So look, I think they've all touched a nerve. The president, some of the market participants you mentioned who people have a great deal of confidence in, and that is, are companies functioning too much for the short term? It's a really good question. Now, are quarterly earnings or quarterly guidance, which are two different things, are they driving that short-termism? Is it a combination of things? I think it's a combination of things. And I think it's a question we should be asking. I think it was good of the president to raise it. I think it's good of, I'll mention them, Buffett and Diamond to raise it. But I would not say the sole driving factor is quarterly reporting. No, we have a completely different governance mechanism today than we did 15 years ago. 15 years ago, the ability of a minority stockholder to directly and quickly influence a board of directors and therefore the direction of the company was quite low. Today, as a result of a series of regulatory changes, market changes, the ability of a minority stockholder to substantially and quickly influence the direction of a company is high. That's a big change.
Well, let's put it this way. Would you envision any difference in either guidance, quarterly guidance, or reporting within the next couple of years?
So guidance, we don't require guidance.
Right.
Guidance is a voluntary exercise that some companies engage in, some industries more than others. It's not for me to tell people to do it or not to do it.
Would you think it would be positive if more people did not do it, realizing it's not your call?
One of my big themes is rarely does one size fit all across the marketplace, but I'll leave it at that. On the quarterly earnings, an interesting thing is there are a number of markets around the world where quarterly reporting is not required, but companies report quarterly anyway. So, it's not just a question of whether we require quarterly reporting or not. What does the market expect? Again, going back to one size does not fit all. There may be a size of companies, particularly smaller emerging companies, where quarterly reporting is not what the market wants or would expect. And again, these are
gradations like that things that the SEC could involve itself in? Required for under.
We could, and I'm not going to move in any quick direction, but it's a good question, right?
Yeah.
Are some companies, let's just pick numbers, 100 million to $1 billion, emerging growth company. Is that a company where, if it came to market, you should require quarterly reporting, or you should allow them to opt into some other, semi-annual or something? I don't know. Good question. It's a good question. I don't think quarterly reporting is going to change for our top names anytime soon.
Got it. And final question before we go to the audience. Let's go back to where I started with the short seller enrichment commission. Some people think you went too easy on Elon Musk and Tesla. What do you say to that? And are you going to do anything about him taunting you on Twitter?
So no, I'm not going to do anything here about any of that. No, it's not my. I put out a statement on this because, and it's rare that someone would do that, but there was a great deal of Main Street investor interest in this issue, and I took the opportunity to let our Main Street investors know how the commission looks at enforcement actions, and I'm not going to go beyond that statement.
You're comfortable with what you all did?
Our enforcement division has terrific people. I'm comfortable with just about everything they do.
Yeah, but the fact that he sent that tweet is not an indication, in your view, that he is going to be defiant of what was agreed to?
I'm not going to get into a particular discussion, but I appreciate you have to ask.
Okay, who's got a question? There are mics that will be roaming around to find you.
Chairman Clayton, thank you for being here today. My question is on the upcoming roundtable on the proxy process. In your announcement, you listed a number of topics that could be covered, including retail investor participation, shareholder proposals, and proxy advisory firms. I'm wondering if there's a certain topic that we can expect to be an emphasis at the roundtable.
You know, I don't think there is a certain topic. You listed a number of items that all are related. And we're going to look at the proxy ecosystem, you know, the participation of retail investors, the importance of proxy advisory firms, the plumbing, the thresholds, all of this to say, you know, is the way that we are regulating shareholder engagement appropriate? Are we getting it right? And you know, I think it's time to do that. I applaud our division of corporation finance for leading the way on this, and we should have a discussion about the ecosystem. So I'm looking forward to it.
Who else?
There have to be more questions. You did a pretty good job if there are no questions.
Bill Hoagland, you got a question?
Since he doesn't deal with fiscal policy or monetary policy.
He's got a mic for you.
No fiscal policy, no monetary policy. That's why we're bipartisan.
Okay, we'll go right over there.
So I got a mail the other day which told me, it was an interesting one because you just commented on this before. There's a fund that's a blockchain for private equity and alternative investments, fully decentralized capital market, democratizing the investment of these alternative classes through modern cryptographic methods. How do you guys work with that, or what do you do?
So, you know, I'm gonna ask a question, and I don't mean to be, well, I'll just say this. It's a question that I ask people who come in to see me about these issues. One of my issues with decentralization is who's responsible? Like, we kind of have built a capital market system around clearly defining responsibilities. The responsibilities that are on you as the investor, you know, and you take those risks, but there are responsibilities that are on an issuer. You know, my favorites are like, hey, you're a public company, you got to have audited financial statements that give you a true picture of the financial status of the company. That's like, and you're responsible for producing them. And if they're wrong, you know, you have a high risk of liability. In a decentralized world, how do we assign responsibility? It's a question that I start with around issues like this. You know, if something goes wrong, who's responsible? So I say to retail investors, look, and I've said this publicly, I say, look, if you are taking your money and you are depositing it offshore to trade on a platform offshore, and something goes wrong, I would like to be able to do something to help you, but the likelihood I can is very low.
Got one right here.
Just had a follow-up question on that one. Crypto assets are a classic situation where there needs to be cooperation across regulators and perhaps other bodies and global cooperation as well. It's a really tricky problem, as you know from looking at it. What do you think is the best way to try to find a coherent solution to the issues, as opposed to sort of piecemeal from every regulator going from their own?
So what I can say is that the international bodies that I'm involved with FSB, the Financial Stability Board, IOSCO, the International Organization of Securities Regulators, we are focused on the very issue you say, which is in a cross-border product. The need for international cooperation is great, particularly if, said another way, if you have asymmetric regulation, things are going to flow based on that regulation. Is that easy? Is that easy to say and hard to accomplish? Yes. Yes.
Hi, Victoria Guido with Politico. I just wanted to ask, since you sit on the Financial Stability Oversight Council, clearly FSOC is moving toward, looking at policing activities rather than, designating individual companies. And I was wondering, first of all, whether you feel like the history that FSOC has had, the short history that FSOC has had with designating companies, whether that's sort of shown that that wasn't really an effective approach, since only a very small number of companies were designated, and now they're all basically getting out. And then also whether you could comment on whether there are any types of activities that you're sort of worried about and looking at as you think about that type of approach.
So look, I'm going to go to the second because it's not appropriate for me to comment on behalf of FSOC. It's a body. But in terms of activity, as I said at the beginning, I'm constantly on the lookout for activities that would cause risk to either the U.S. financial system or our global financial system. I think forums like the FSOC are a good idea, but for that, we got to be forward-looking because we all know from history that the risks and problems of yesterday may give us an indication on tomorrow. They're never the same. So, where am I worried, about tomorrow? Those are questions I ask myself. We've taken on a great deal of debt across all economies, the U.S. economy, European, Asian, in different forms. We've had a substantial amount of market intervention by central banks in different ways. I mean, it's not been the same in all places. And as we transition back to a more normalized environment, will we see things that, may give rise to concern? I would expect so. Anytime you make substantial movements in monetary and fiscal policy, which I'm not responsible for, but I do monitor how they get transmitted to the market, you're going to have issues that arise.
Let me ask you a related question to that. You reiterated that you're not in charge of monetary policy. I get that. But the president's comments on this stuff illustrate the way in which he disregards some of the norms that previous presidents have applied. And I wonder, in that light, how much does he get up in your business? How often?
So look, I'm not gonna touch any of the that's just not appropriate. What I will say about the SEC is we're an independent agency, but that doesn't mean we're an isolated agency. I have not had a great deal of contact around any of these issues, but I want contact. I want people. I want most of all our Main Street investors to tell us what they're thinking. But I want consumer groups, industry groups. Independent doesn't mean isolated.
Right.
I want to know what people are thinking.
How often does Trump call you?
Other than to offer me the job, not a lot. Not a lot.
Okay. Never?
Can't say never, but I can say not a lot.
Yeah. Okay.
Chairman Clayton, thanks for your participation today. You mentioned Main Street a couple of times today. LIBOR is in trillions of dollars of cash products. What efforts is the SEC taking to help raise awareness, begin to identify solutions? Yeah, well, this is a great start.
Look, $200 trillion notional market. What is it? 10 to 15 trillion of outstanding, what I'll call institutional product, not notional, but cash market product, and $1.5 trillion of consumer products. That's a big market on a $19 trillion economy, right? I mean, so this is a big deal, and we need to try and get it right. We have time, but it's going to take a lot of work.
And one more?
Two more. Now the fact that you gave Michaels an opportunity, you know.
Been so patient.
All right.
Go for it.
No, go ahead, David.
Dave Michaels with the Wall Street Journal. There are signs that the SEC is scrutinizing fees charged by stock exchanges more closely, particularly with respect to sales of market data. In fact, your director of trading and markets recently suggested as much when he said that the commission has to do that as a result of an adverse decision you had before the DC Circuit in the OCC capital plan case. I was wondering if you could talk about your own views on exchanges selling market data, and is this an area where the SEC should demand more transparency from the stock exchanges?
So I have no, David, I have no definitive views on the sale of market data by our regulated exchanges, but I do think it's an area that we should look at. There, you know, in terms of engagement with market participants, it's an area where people who come to see us say, you should look at this.
Would you join me in thanking? Oh, wait.
We had a Main Street investor.
Hold it. All right.
Some state regulators have said with regard to cryptocurrencies that despite the plunge in Bitcoin price, fraud continues to be a growing problem, the incidence of fraud and other securities violations. Do you anticipate in the future growing problem with cryptocurrencies, and why? Especially since the SEC has taken such a strong stand.
Look, your question is, it's a sobering one. Do I expect to see fraud in the future? Unfortunately, I've come to realize in this job that there are a number of people who prey on our most vulnerable. And securities offerings or product offerings are an effective way to do that. And anytime there's a new and hot thing, the fraudsters gravitate toward it. And we've seen that in the ICO market. We've seen it in the cryptocurrency market. We have literally grabbed people who are heading for the border with what I call bags of cash after having committed ICO fraud. And you know, as long as it remains something where people think they can do very well very quickly, and it remains unregulated, it is a fertile ground for fraud. Those are the types of fertile grounds for fraud that we try to do the best we can to reduce.
Thank you, Mr. Chair. You join me in thanking the chairman?